In this video, I'm going to show you how to buy your first investment property without showing your tax return or your W-2. And if you enjoy this content and if it does add some value to you, please show your boy King Kong some love. Boom, smash the thumbs up. If you're new to the channel, welcome to the family. Be sure to, boom, smash that subscribe button. And let's rock and roll. It's called a DSCR loan. These types of loan has been used by some of the biggest real estate investor in the game, which stand for debt service cover ratio. Basically, the bank will loan you on this investment based on the income, the rent that property brings in. They don't care about your tax return or your W-2. All they care about is how much income this property brings in and what is the debt service ratio on that property. So the debt service to ratio needs to be at 1.25, and here's how you calculate it. So basically you take the net operating income on the property divided by the debt, how much is owed on the property. Let's just say that you're able to collect $1,250 in rent on that one property. And let's just say the mortgage on the property is about $1,000. You take the rent divided by the mortgage, that'll give you a 1.25, which means this property is qualified for a DSCR loan. And to qualify, you need to have at least 20 to 25% down, and your credit score only needs to be between the 600 to 650. As a bonus, I'm going to show you how to leverage this first investment property to buy a ton more without any extra money coming out of pocket by leveraging the bank's money. And this, my friend, is called the BRRRR method. Let me explain. The BRRRR method, it has been used by some of the biggest real estate investors in the game to leverage the bank money to create generation wealth by owning a ton of property without having any money actually into the property. So BRRRR stands for buy, rehab, rent, refi, and then basically just repeating the process. But let me show you how to buy a piece of property the right way. So for this method to truly work, you must buy the property at a 30% minus repair. Let me break it down. So let's just say that the property is worth, the ARV on the property is $100,000. So basically after you fix the property up, the property is worth about $100,000. So you automatically take 30% off of that, which means now you're sitting at $70,000. And let's just say that it costs about $10,000 to fix or renovate the property to put it in perfect condition. So which means you need to buy the property for $60,000. You bought it for $60,000, you spent $10,000 into rehabbing the property to put it in rent-ready condition. So now you're all in on that property for $70,000. Let's just say that you're able to rent that property out for $700 a month. Next, you would go to your local bank and you tell them that you want to do a cash out refi on one of your property. A lot of you will be like, well, Kong, I don't have the $70K. Well, that $70,000 could come from private money or hard money lender. The bank is going to send out an appraiser to actually appraise the property and see how much it's worth in today's market. This is something that the bank would do every single time when you get a loan or you do a refi on your property. Since we already did our homework, we knew that after we spend the money, fix the property up, that it's going to worth $100,000. When the appraiser comes out to appraise the property, all right, we know that it's going to get appraised for around $100,000. So let's just say that the appraiser goes out, verify the information, and said that, hey, this property is now worth $100,000. The bank is going to loan you 75% on the appraised value of the property. The property is appraised for $100,000. The bank will loan you 75% on it. It's about $75,000. But you still have a $70,000 loan with your hard money or your private money lender. But that $70,000 will get paid off is because now you have a new loan with the bank. So the bank basically gave you $75,000 for this property that's worth $100,000. You take the $75,000, you're going to pay it off your private or hard money lender, and all of this is going to be done at a title company, all right? It's not like the bank gave you $75,000 and then you have to go pay your hard money or your private money. All of this is going to be done in a title company. So that's the way it's legit. Everybody gets paid. All the paperwork is done correctly. So the bank will loan you $75,000, right? Just in this case, they give you $75,000. The hard money lender or the private money lender is going to get paid off. So if you take $75,000 minus $70,000, now you're left with $5,000. This, my friend, is tax free. So you actually get to keep this $5,000, do whatever the F you want with it, and you don't have to pay any taxes on this 5Gs. You don't have to pay taxes on the $5,000 that you made from doing a cash out refi is because this is considered a loan, not a capital gain. You're not gaining anything, all right? It's a loan that you're getting from the bank. And this is how the rich stays rich and get wealthy and stay wealthy and pay very little in taxes, is because this is what they do. They do the Burr method. They just keep, and you can do this as many times as you like. So now that you pay your private money lender back the $70,000, well, guess what, my friend? Now you have that person, right? Now you have that connection, that 70 G's, all right, plus the $5,000. Now you can go out and go do it again, buy another property, doing the exact same method over and over and over again. So which means you can just reuse the $70,000, all right, and go buy more property without any new money coming out of pocket. Some of you would be like, well, instead of a $70,000 loan, now you're at a $75,000 loan, which means you just increase your debt. Why do you want to do that? That is stupid. It doesn't really matter how much the debt is. You know what matter? What matter is as long as the rent covered the debt. So your renter is the one who's paying off your debt, while you as the landlord, you're getting all the benefit. Depreciation, right? Tax write-off, appreciation, which means that over a period of time, 5, 10, 15, 20 years, after 30 years, okay? So after 30 years, once this property is paid off, guess what? It's probably double, triple, or quadruple in price depending on the location. Worrying about like, oh, instead of a $70,000 loan, now I'm at $75,000. I just owe more on the property. Doesn't even make sense to owe more, right? Because a lot of us are brought up where we don't want to get into debt and to pay everything off, to own everything free and clear, right? To pay cash for everything. You see, that's the poor mindset. How the rich get richer and stay wealthy is they understand to leverage debt. And as long as you're a renter, you collect enough rent to cover your debt. You, my friend, are not paying for the debt, but the renter is the one who's paying for it. And typically, if you do this right, you're not just paying off the debt, all right? The mortgage, utilities, all the expense that comes with owning a property, but you should also cash flow about $250 per unit. And that, my friend, is called the 1% rule. So as long as you buy it within the 1% rule, you should be able to use the rent to pay off the debt, but also cash flow from the property. And let me just give you this quick example. So let's just say that you bought the property for $100,000, or you have a $100,000 loan on that property. All you need to do is you just need to make sure that you can get $1,000 back in rent. So that, my friend, is called the 1% rule. Now, the 1% rule will apply in, different market. So in my market, in a hot market like Seattle or New York, you're probably not going to get the 1% rule, all right? Because it's very, very hard, but it also appreciates really, really quick. Anyways, that's like a whole nother video. But in this video, I just want to keep it simple, showing you guys how to buy your first investment property and just using the money and just cycle that money over and over again to acquire more property. And hopefully, eventually over the next 10 to 20 years, all right, you're able to build up a good rental portfolio that can actually spit you $10,000, $20,000 a month in cash flow. But here's something I want you to understand. The cash flow game is a slow game. It's a 10 to 20 to 30 year game plan. It does not happen overnight. So if you hate your JOB, or you're stuck at the JOB that you don't like, the last thing you want to do is start buying rental property. I always say this to everyone that follow me, is you got to focus on building a business first. You got to focus on your active income before you worry about your passive income. You need to build a business where you can get to the point where you make at least 20, 30, or 50,000 a month. That's when you know, my friend, that you're ready to start buying some real estate, some passive income. Now listen, I say this is maybe you're in your 20s or your 30s, but it depends on where you're at financially, all right? What's your goal? All right, if you're happy with your JOB and you just want to start accumulating and buying up some rental property, then you can start doing it. Or maybe you're in your 50s, right? Or you're 60 and you're like, hey, I don't want to build a business, all right? I just want to start building up my passive income. I need to offset my taxes. But I always suggest the younger people to focus on building a business first before they worry about buying passive income. Because when you buy passive income, it's going to slow down your growth because you're taking the money that you have liquid that you can invest and build a business. Instead, you take that and you dump it into a house, a piece of real estate, and it typically will sit in there for at least 5 or 6 months until you can pull the money back out and do it again. Anyways, I hope you find this video valuable, and if you truly enjoyed this, make sure you show your boy King Kong some love. Boom, smash the thumbs up. New to the channel, welcome to the family. Be sure to, boom, smash that subscribe button. I wish you all the best. Until next time, take care, and let's go get this money.